Buy gold, go to cash, find some safe haven. The market hit another all-time high. A collapse has to be on the way, or is now a good time to invest? Let's get into it. Hey everyone, my name's Aiden Murphy. I'm a financial advisor with Sentinel Financial Group, and man, am I looking forward to today's video. It's been over a month since the S&P 500 hit an all-time high and has continued to perform since. Inevitably, this happens. The market hits an all-time high, and as investors, we start immediately asking some questions. Uh-oh, should I be worried? Should I be nervous? Is a collapse or serious downturn only a matter of time? What should I do? Well, to take from Warren Buffett, be fearful when others are greedy and be greedy when others are fearful. For those of you that send me those articles from Business Insider and elsewhere saying 2024 we're doomed and headed for a deep recession, I don't have a crystal ball, and obviously past performance is not an indication or guarantee of future results. But today, I'm here to hopefully put some minds at ease by providing some perspective. All right, allow me to first just say that the fearmonger who writes these articles knows no more than I or my peers about when the next recession or downturn is coming, but I believe that a little context can go a long way for you. So let's think about the S&P 500. It's the most often quoted index or market that we're looking at. It did recently just hit a new all-time high. If we look at this graph, we'll see that the previous high was in January of 2022. Then we had 2022 as a down year, and 2023 was a great year, and now we are back and beyond these all-time highs, taking about 2 years to get back to where we were and then some. Now, let's talk about scope, and here's the theme that I want you to notice in today's video. When it comes to you that are all doom and gloom, if we look at a short enough time frame or through a small enough lens, you will eventually be proven right. Let's say that in 2019 you were pessimistic. Well, you'd surely be vindicated when the pandemic hit, and maybe everybody thought you were a genius. Or in 2022, when we actually had negative returns, you'd again be proven right, and your counterparts would think that you're an investing wizard. Now, here's the context. Understand that you're all thinking about this far too near term. Zoom out. If you zoom out, you'll see how important this is, and you'll see it's just time in the market and not timing the market, as it were. Here's where people start to outsmart themselves and think that the market can only go down from here, so they ask, should I pull everything out, wait for the market to bottom and put everything back in? Or hey, the market hit an all-time high, doesn't that mean a recession's coming? What I can say is that we know markets are not predictable in the short term. I agree with the sentiment that more money is lost trying to avoid the next downturn than simply just participating in it. If you don't believe me, let's take a look at some data from Fidelity showing that if you invested $10,000 back in 1980, that 10K over 42 years up until 2022 would have become $1,082,000, around 100x your money, a big number. Now, what if we were to miss just the 5 best performing market days and we were not invested just those 5 days? Your 10K would now turn into $671,000. If you missed the best 10 days in those 42 years, your 10K would only be $483K. If you missed the best 30 days, instead of $1 million, your 10K would be $173K. And if you missed 50 best days, you're left with $76,000. But what about those that claim if you missed the worst 5 to 30 days? Well, here's why it doesn't work. If you stay always buying ABB, you don't need to worry about this. But for you pessimists and gurus, not only do you need to be brilliant and sell right before the market goes down, but you also need to have a crystal ball and be brilliant to buy back in at the right time. This strategy might be accomplished by a tenured, experienced trader, but for the general population of investors, ABB, always be buying, is the way to win. Staying the course, being lazy, and not getting emotionally involved in the markets is something that will work for everyone. Now, what about those that don't care for the best and worst days? They only care about the herd moving markets, considering that markets are momentum driven. So what if I just wanted to pay attention to investor sentiment? When sentiment begins to wane, I'll pull all my money out, and when it begins to improve, I'll get back in. Can't I just, get it mostly right by following the general feeling of the market? Well, to that, I'd point to our trusty and reliable media that can help us predict what's coming. Let's look at some headlines and see what happened after the sentiment drivers' predictions. Look here, Financial Times, they have to know what they're talking about. They said that, quote, the risk of a double dip recession is rising, and that came out on August 23rd, 2009, following the 2008 collapse. The rest of the story goes that over the next 3 years, the S&P 500, rather than taking that double dip, did 37.6% total return over that 3-year period. But let's get back to our short-term lens and look at that volatility. So whoever wrote that article back in 2009 probably thought that they were right about a year later. Then zoom out. By August 2011, once again, massive volatility. Understand that if you look at it historically, there is an intra-year volatility ranging between 12 and 14%. every year. So just know that there's going to be a point during 2024 where the market might lose 12 to 14% from the high that it was at. But do not let that spook you. Zoom out. Now, Mercury News states, quote, "The economist that predicted the busted housing bubble says another recession is coming. And since he called it once, he must know that about it this time around." Well, that was written July 22nd of 2014, a number of years beyond the Great Recession. But lo and behold, 24.7% return over the next 3 years. Again, you gurus who sold while the market was panicking will look at January 2016 and say, this article was right. But if they didn't buy back in just 3 weeks later, you miss all of that run up. And not many will do that, and here's why. You usually sell because of emotions of fear, and it takes healing time after selling for comfort to recover, lick your wounds, and feel comfortable investing again. Problem with V-shaped recoveries and up markets, you will likely have missed the train, so don't even waste the effort. How about the Wall Street Journal? Similar to today's environment, quote, "Why soaring assets and low unemployment mean it's time to start worrying." July 2017, over the next 3 years, the S&P had a 32% total return amidst an uh-oh environment, and that includes the beginning and middle of a pandemic. The point I'm trying to make is not to allow your emotions to take away from your ability to build wealth. Have an all-weather plan and do not let the markets, the economy, or voices around you dictate how your plan changes. You need to remove the emotion from all investing. Understand that patience, time, and consistency is what will build wealth. Making a quick buck off a meme stock or following the latest fad may work in the short run, but long term, this is not how millionaires are made. Simple, sound investing works. Now, I can't predict what will happen in the market in 2024, but what history indicates is that if we take a look at it in any short enough time frame, the fearmongers will be right. And if we look at it in any 3 to 10 plus year time frame, we know that markets do appreciate, and you just better make sure that you're there to get a piece of the action. So I hope this provides a bit of context and mental reprieve. As humans, we have a tendency to catastrophize our outlook when things are going pretty well. There's even a phobia associated with this known as cherophobia, or an aversion to being happy, or in this case, believing that something bad is going to happen just because something good has happened. And this is exactly why we can't allow human nature or our emotions to dictate what should be an emotionless practice like investing. I love addressing this stuff because though all the voices will say buy gold, go to cash, find some safe haven, this panicked bailing out might not be what is in your best interest, and I'm here to arm you with information to keep your emotions in check and empower you to invest with a sense of what is going on and what is best for you and your financial future. 2024 should be a wild one. Stay the course, keep pounding the stone, and be sure to consult with your financial professional before doing anything too drastic on this roller coaster ride. If you don't have someone to go to, or you're just interested in learning more about our team's 2024 market outlook, send me a DM today, and be sure to follow along for more. Investing in an election year coming up next. Thanks for tuning in. Catch you guys later.